All right, welcome to the risk management course. Let's go ahead and actually present this. All right, so I'm just going to be a nice rundown of some big risk management, techniques, strategies, things to keep in mind, just from what I've seen the past year of questions that I've had with people, talks that I've had with people, primarily more on the beginning to invest side, because a lot of people are jumping into the game now, and one of the biggest things that kills you or your account rather is not having proper risk management. People are so focused on getting huge gains. People are so focused on growing their account as quickly as possible. And people are focused on having, a perfect, flawless win rate, which really creates an issue when you start holding the bag. All right, so we're going to cover all of that. I'm going to go ahead and start with it. So, position size, right? You want to make sure that you're trading relatable to your account size. And here's the biggest thing. So I run a group chat for options trading. We do some options call outs where my analysts and I will share trades we're getting in, just so you can see what we're doing with your account. Now, people will take the same trades that we're taking, but you have to look at it a certain way. So if I call out a trade that's a $500 options contract and your account is $510, right? And you take that trade, now you put yourself in a position where pretty much your whole account is at risk, right? And so for me, I might be trading with the $10,000, $20,000, $50,000 account. If I take a $500 trade, even if it gets wiped out, that's so minimal. That's so minimal, so minute that it doesn't even affect me really. And I wouldn't let the trade go to zero, but even though I take a 50% loss, right? A 50% loss isn't a bad loss if it's on $500 and you have a $10,000 account. That means you just lost $250. No big deal, right? But if you're trading the $500 or $1,000 account, you just lost, 40, 50%, not just on the trade, but on your whole account. Right. And so what I put here just for you to really visualize it is that people don't realize that there's a difference between the percentage gain that you need to recover from a certain percentage loss. Right. So a $2,000 account dropped down to $1,000 is a 50% loss. Right. But for you to go from 1,000 back to 2,000, you need a 100% gain. So again, it's easier to lose it mathematically, right? It's easier to go down than it is to go up. So that's why it's really important that you're making sure that with your positions that you're taking, taking into account, hey, what's the maximum I'm willing to lose on this trade? And does it even make sense for me to take this trade with my account size? All right. So my rule of thumb for myself personally is any trade that I take, typically I'm not putting more than 10% of my total account balance. Sorry, that's the dog. I'm not putting more than 10% of my total account balance on that trade, right? So if I'm trading a $10,000 account, I'm not taking a trade with more than $1,000 allocated. And usually I don't go over 500. But if there's some time, if I'm trading the option contract and there's, a month or more of time on it, I'll do 1,000, but 1,000 is where I stop at. And within that, then I also set different stop losses, which we'll get into, where I say, out of my $1,000, I'm only willing to give up 250 or even maybe $500 out of this trade before I'm like, you know what, that's it. I'm cutting it, I'm moving on to something different. So you got to make sure that you realize trading is a long-term game. It's not about how quick can I go from $100 to $1,000,000. It's about how long can I continue to consistently bring in the money, right? And I'd rather go from 1,000, or I'd rather make 1,000 a week consistently than shoot off from 1,000 to 52,000 in 3 months and then lose it all, the next 3 months because I'm just trying to see if I can turn that 50,000 into $1,000,000, right? So make sure you're playing the long-term game, thinking about the bigger picture, keeping in mind the actual purpose of what you're trading for. I always talk about what's your why with your trading. If it's to pay bills, get to a point where you can consistently use the profits to pay bills. If it's to become a millionaire trader, then compound and focus on a long-term game. You don't have to go from 0 to $1,000,000 in a year. It can be a process of 5 years if you're becoming a millionaire with your trading. And really, the longer you plan it out, the easier it'll become because you can be less aggressive. You can mitigate more risk. Now, stop loss is something that people oftentimes don't have a hard stop. They use a mental stop. Right? And so what a stop loss is, just to get it out there, is you putting in place a price point or maybe a percentage, but it's just something that you're setting and saying, this is where I'm stopping my loss. All right. So if you get into a trade, at $10, I would say, hey, once it goes down to $9, I'm out. Or if it goes down to $8, I'm out. Because I had a reason for getting in the trade. And this is why I always talk about reassessing your position instead of just holding it, which a lot of people do, is I just hold it and hold it because it's going to turn around, right? I'm hoping it's going to flip for me. You have to reassess it. Say, now, if I wasn't in this position at all, if I had no money invested in this, would I still put money into it today? Right? And a lot of times the answer is no. So then you have to say, well, why am I still letting my money sit there? The other thing is, the longer you're keeping your money in something that's losing you money, not only are you continuing to lose money, but you're also withholding yourself from other opportunities that could make you money. So you got to make sure that you reassess the position, and say, when I get into a trade, this, if it goes here, if it does this, right, whatever this is for you, that's when I'm out. And it could be based on indicators, it could be based on moving averages, RSIs, price levels, percentage. Once I'm down 5%, 20%, 50%, whatever it is, right, that's where I cut it at. Now, the other thing is it allows you to trade your plan and execute according to your plan. So what I'm talking about more is, having a set plan or system that you should be able to have a plan that you can give to somebody else and they can trade your account, perfectly, not perfectly in the sense of like same way that you would, but they should be able to execute based on what the rules for Jordan is. He gets in trades when they meet this criteria, he gets out when they meet this criteria. Right? His stop loss on every trade is 20%. So if Jordan's on vacation somewhere, no computer access, and I'm in his account, okay, this is at 20% loss, close it, right? Simple, no confusion, no thinking about it. You're keeping your emotions out of the whole equation. Now, on the flip side, you have profit taking and profit targets. And it's kind of the same thing. It's kind of the same thing where you can say, hey, same thing, for certain percentage, I'm taking profits, right? 5, 10, 15, 20, 30, 100, right? Whatever it is, this is the percentage gain I'm looking to make. And you can have a price target as well. Same thing with indicators. When it hits a certain moving average, if the RSI moves to a certain spot, then I'm out, right? So the other thing with profit, and I want to actually show a resource, is the compounding effects. So I pulled up is calculator.net. I use it a lot for planning out different things with my accounts. And this is just going to show if you start with $1,000 after 10 years, and what I really want to do, we're gonna treat this as weeks instead of years. So we're gonna put 52. It says years, but we're gonna treat it as weeks. So after 52 weeks, let's just say on your total account you gain 4%, right? And we're not adding any extra money. So it says annually. That's because we're doing the years. But 52 years with the 4% growth in your account every week. So this is going to go for the whole year because this is weeks. So you go from $1,000 to 7,686, right? And that's just with 4% growth. So if you're buying shares, 4%, something that's fairly reasonable, right? If you're doing options, you can have higher than that if you're consistent with your strategy. And don't get caught up on another thing people mess up all the time is getting so caught up in the dollar amount and not the percentage amount. Because once you get the system down and your percentages line up, from there it's just zeros, right? So yeah, you look at it and say, man, 1,000 to 7,000, that's not a lot, right? A lot of people first instinct might be that. But if you drop another zero in there, now you took 10,000 to 76,000. That's a lot, right? Do it again. Let's say you did this with the $100,000 account, which you could. It's a little harder to trade with higher numbers just psychologically. But if you have the system works, it doesn't matter how much money you're using because the system is the system, right? So now it's, hey, I took $100,000 and I almost turned it into $1 million in a year, right? Now it's all different, but it's the same exact thing that you were doing with the original $1,000. So let's go ahead and pull this back up. Let this load, right? So you want to make sure that you just focus on compounding. That was just, if I make 4% every week, not if I make 100%, if I flip my account every month, it's just 4% every week and you just consistently build it up. All right. So that's how you can get to the bigger goal without incurring a lot of risk because you're trying to do everything super fast. Now, the last thing with this is runners. And runners, it's really something that you hear a lot with the options trading is where you're taking a contract, say you're buying multiple contracts. If you buy 5 contracts on an option and the option pops off in a direction that you were planning, you might be up 100%, 50%, whatever it is. You can go ahead and lock some profits in, right? So you could sell 3 of those contracts. So now the profit that you made on 3 of those 5 contracts back in your account along with the initial investment. And then you have what we call runners, which is contracts that still have time left that can go even higher. But at the end of the day, you've locked some contracts in or you locked some profit in. So one of my biggest things is, I like to trim, right? So maybe once I'm up 30%, 40%, I lock in a little bit of profit. And then once I hit 100%, that's where I'll cut the position in half, right? So if you have 2 contracts, you spent $100 in total. If you go up 100%, now you're up to $200. So you could sell one of the contracts, get $100 back into your account. That's what you spent, right? $100. So now you have all your money back. It's a free trade. Even if that last contract goes to zero, which you wouldn't let it, but even if it goes to zero, you still haven't lost any of the initial investment because you pulled it out, right? So you can let it run on and run on. And it's happened plenty of times, especially in the group chat where I've called trades, other people have called trades, and I paid $400 for a trade. It went up to maybe $900. I got out, locked in the profits, and then it ended up going to $27,000. So I was like, wow, I should have left the runner because that one could have sold for 27,000 after I locked in all my profits at 900. So it's something to keep in mind. It works the same way when you're trading shares. If you have something that's doing a big momentum move, a big breakout, if there's a big news event, and you don't know how high it can go, sometimes you just leave a runner because, hey, it can keep going higher. I'm locking in some profits, but I still don't want to miss out on a bigger move if it's coming. Now, when we're looking at order types, it's important to keep those in mind too. So with order types, and there's a lot of different order types, but I'm just going to go over some that actually relate to risk management. You have buy, sell, stop limit orders, a regular sell limit, and a regular buy limit. All right, and so we're just going to go back to the charts again. So the way a buy stop works, but the stop orders trigger once the price is moving towards a certain point, right? So it would be like, watching the stock and I'm saying, okay, I think this stock is going to go up, but I want to catch it if I know it's moving up. I don't just want to buy it right now. It's not making a move. So a buy stop would say, hey, once it hits, and for this example, let's say once it hits 466, that's where I feel like once it goes past 466, 467, I think that means it's going to keep going. So I'll buy in there. I'll give up being early to have a higher chance of being correct. All right. So I'm putting a buy stop in. Once it hits 467, that order becomes a market order, right? So now it's live. It immediately fills at whatever market price is, and then I'm in the trade. A sell limit is where you're saying, hey, this is the minimum I'm going to take for this trade. So once it hits this, once there's somebody who says I'll buy it for this, sell it to them, right? And so that's how you use a sell limit order. On the other side, there's buy limit orders, which is, hey, the price is at 470. I think it'll come back down. So I don't want to pay 470. I want to pay 467. Right. So I put a buy limit in and I'm basically saying, hey, if the price drops down to 467, then I'm getting in. If it doesn't and it keeps going up, hey, I'll wait, maybe catch it next time it drops. But those are different types of orders you can use to actually be more particular and more strategic with your entries and your exits. So you're not just, I'm gonna get in right now, and then it does what it does. It's hey, this is where I really want to get in at, right? Because with stocks, again, you're buying and selling and trading these. you should have a certain reasonable amount that you're saying, this stock, not even a matter of is it worth this much? Is it worth me paying this much for it, knowing that in the future I want to sell it for more? Right. And so right now, with the market being pretty much at all-time highs, at that point, you don't know where it's going to bounce back down at. But now you're kind of in no man's land where down here around 450, you at least can expect, hey, it's going to go back up to all-time highs at some point. So I know I'll be able to sell it off for more in the future. Once you're kind of at all-time highs, hey, it can go higher, but I don't know when I'm going to sell it. I don't know if it's really going to go higher a lot and then just come crashing right back down. Kind of iffy, right? But those are the different types of orders that you can use again to just be more strategic with how you're maneuvering and how you're trading. Now, diversification works really when you're trading and when you're investing, right? And the big difference between trading and investing is trading is active and investing is the longer term, more of a passive approach, right? So you want to look at the fact that stocks that are related or in the same sector, same industries, oftentimes move in the same direction. So when you're looking at, things like Apple, Microsoft, Amazon, those big tech companies, they don't move the exact same, right? Because they're individual entities, but a lot of times, you'll see tech moving in one direction, right? You might see energy and oil moving in one direction, retail stocks moving in a certain direction, right? So whether you're trading or investing, I think it's important as far as your risk management goes to make sure that you're not solely focused in one spot, because if that one thing takes a hit, everything you have pretty much takes a hit, right? So you will want to look at, hey, this is what I do as far as like investing. When I'm looking to actually put money in like a long-term position, I'm looking at the different industries and sectors and I'm saying, what's the best, one or two stocks out of this whole area, right? So if we're looking at fast food, there's McDonald's, right? We can say there's Domino's, there's Wendy's stock. There's some like young brands that owns Burger King, Taco Bell, right? So there's some different things set up there. Out of all these options I have, what's the best one or two? And I'll go with that, right? Those are the strongest at the pack, right? And then I'll move on to the next sector, right? What's the best tech stocks? What are the best semiconductor stocks, right? So again, you want to have it spread out so that, one thing takes a hit, you're not getting beat up. And that goes, like I said, whether you're trading or whether you're investing, because news can come out at any time. That's one thing that we really don't know is whatever news is going to drop. And if it drops and it affects one industry, you can either get a big boost or you can get a big drop. So it's good to have everything spread out. Now, averaging down is something you have to be cautious about. It can be beneficial, but this is where that reassessment of the position comes back into play. So what averaging down is, say I buy a stock at $10, and this is just quick brain math. Matter of fact, I'll do it this way. Now I know the answer is gonna be right. So if I buy a stock at $20, it goes down to $10, right? So now I'm at a 50% loss. If I buy the same amount of shares or I put the same amount of money into it that I did, essentially like doubling my position that I did when it was at 20, now that it's at 10, my new average cost per share or cost per contract, if we're doing options, is now 15. So before, if I just stayed at 20 and say it went down to 10, I never bought any more, and then went back up to 17 or 18, I'm still at a loss. However, if I blow it up some more while it's at $10, and now it moves up to 15, which is my new average, now it goes up to 17, I'm actually in profit, whereas I would have been at a loss. So it can benefit you after you reassess and you say, given the situation, whether it's news, charts, whatever it is, I would still want to add more to this position, right? When you do that and it works out, great. Now you can get out earlier and you still have profit. On the flip side, if you're doing it and you just add to it, you can lose more money because you are investing more money into it, right? Which is why I'm stressing the reassessment of the position, is because you're adding more money into it. And even though your cost has dropped down, right, or your average cost has dropped down, you still put more money in. So it lowers the price, right? So you can have a higher chance of profiting when it goes back up. But again, you want to make sure that you're not just doing it just because. I have a one average down rule where if I'm in a trade, I specifically options trades. If I take an options trade, I'm on a swing and I go down 50%. If I look at the chart, if I look at my reason for entering, and the reason I entered is still valid, and if I said, hey Jordan, if you weren't in this trade already, is this a trade you would take? And if that's the answer is yes, I'll get in, I'll add more money to it, I'll average down. If the answer is no, I'm cutting the position, I'm moving on. Right. So averaging down can be helpful, but it can also screw you over if you don't reassess the position. All right, let me make sure that was cool. All right, hedging. And we're actually gonna pull back up the charts again. So hedging, what that is you looking at, you're protecting your position, right? So if you're bullish, hedging would be, hey, I'm going long, I'm buying stocks, I think the market's gonna go up, but we might have a drop right quick. So let me try to make a little money off the drop to negate some of the losses I'm taking on the move down from my other positions. That's all a hedge is, right? It's kind of like insurance. So what we're looking at right now is the VIX, right? So VXX, you can actually buy this. There's a couple different ones that you could do. You could do VXX, you could do UVXY. But what this is, basically it's just tracking the volatility in the market. And usually the way it works, we'll look at it is from November to December. Usually what happens is when this is going up, the market is going down and vice versa, right? So we see from November to December had a huge run up. And now if we look at SPY, which is tracking the overall market, we see from this part of November down to December, it had a big drop, right? So if you were predicting that drop to come on, or if you're trying to make some money off the drop, say you already had shares of SPY, you weren't selling them off because you're holding them long term, but you wanted to make a little money on the move down, one thing that you could do is buy into VXX. Now, on the flip side of that, you have what's called inverse ETFs, which literally are set up to do the opposite of a regular ETF, right? So like SPY again, right? We see it made that move down from November, middle of November to early December. And then if we look at SH, which is the inverse ETF, we see some kind of the same thing we saw with the VIX, where it moved up. All right, and we can even look at the percentages. So let's go from this low right here on the 22nd up here on the 3rd. So that's a 5% move, about a little bit higher maybe. So from the 22nd to the 3rd, it's about a 5% move. And then if we pull up SPY from the 22nd to the 3rd, where's the low at? Right about there. Right. So another roundabout 5% move. So it's not pinpoint perfect, right? But again, that's just how you can kind of work against that. So you could buy shares of SH while SPY is going down, or the overall market is going down. Your SH position is going up. And then once you think it's going to flip back to bullish, you just sell it off, collect that money, and you could use it to load up more SPY shares, right? Add to your position. The last thing is put options. The put options, if you're not too familiar with options, it's different. So you have regular, you can buy and sell shares, and options allows you to leverage, the contracts. It's a whole nother story. So I would say check out the options course to go deeper into it, because it really is its own kind of separate world in trading, because of all the different factors that go into it. But in short, real simple terms, with call options, you're basically putting on a bet that a stock will make a certain move within a certain time period. With put options, you're putting a bet on it saying that the trade will go down, or the stock will go down within a certain time period. And there's different ways you can structure them that, hey, as long as the stock stays in the middle, I make money. As long as it stays above this level, at the end of the time period, I make money. As long as it stays below this level, right? So there's different ways you can set it up. But put options will be another way you can hedge, because now you're making money again on a down move. And so just to reiterate, the whole point of hedging is that when your big position, when your primary, bulk position is about to start going down a little bit, you're putting yourself in a position to make some more money. While that's going down, you can make some money on the other side. So the last thing is you want to make sure you're creating the rules in the system, right? And so you want to make sure you have a checklist for your trades. It's all systematic, right? If you're playing or if you're trading and trying to play the market just off your head, you're most likely going to lose. And that's why most people do lose, right? So you want to make sure some things that help me is having a checklist for trades where I have criteria for what's allowable for me to trade, right? So I'll say, hey, out of these certain stocks, so I'm not just trading any random stocks. I'm not trading penny stocks. I'm not trading stocks that are over $1,000. I'm not trading stocks that are below $20. Right. So out of these certain stocks, I need to see an uptrend. I need to see the stock be at a support level. I need to see the stock, form a bullish candle at support after a pullback, right? So having those things in place start to eliminate out of all the possible stocks you could buy. Now we're getting rid of those. Now we're getting rid of those. And every piece of criteria that I'm putting in place is either going to increase my profit potential or increase my probability of success, right? Buying into a stock that's in an uptrend rather than a downtrend automatically increases your chance for success because the stock's already generally moving in the direction you want it to move versus you trying to fight the trend. It's kind of like swimming against the current. Why do it? All right. So that's the first thing. Second thing is having a trade log for tracking everything. So again, going off your mind, you might have, 2, 3, 4 different strategies where you say, hey, I'm looking for this and I'll buy it. Or if it does this, I'll buy it. Or if it does this, I'll buy it. When you do that and you're not tracking it, you could go a whole month and say you double your account in a month, right? Or even if you trade in shares, you double your account in a year. Great, right? Now, what caused that? You don't know, right? And so you can see that if you pull up your trade log, you might see that, yes, you doubled your account in the whole year, but you would have tripled your account if you had stopped using strategy C, because strategy C was really losing you money. Strategy A was picking up the money that strategy C lost. And then strategy B was what really was just going crazy the whole time. So now that you look at that, you can say, wow, well, let me just get rid of strategy C and let me focus my efforts mainly on strategy B. And I might keep strategy A around just in case, right? So that's the benefit of a trade log. It allows you to see what trades you're taking and creates accountability with yourself. Because now you have to look at what you're doing. You have to basically declare, hey, this is what I'm doing. I'm Jordan Martin. I'm taking this trade because of XYZ reason. Not, oh, that looks like it might go up. I'm gonna go ahead and buy it. No. All right. And another thing that I did was I shared the trade log for accountability. So I actually made my trade log public for a couple of months, where now all of my followers on Instagram, social media, people can see what I'm doing. All right. And so again, what that allowed for me is I can't take no stupid, crazy trades because people are watching, right? You know how the same way, when your parents come in the room, you straighten up, when you were at school and the teacher walked out, everybody got crazy, but when the teacher walked back in, everybody got straightened up, right? You follow discipline more when you have that public accountability. And the last thing I want to say is just back testing stuff to find what's been successful in the past. So when you back test, all you're doing is, and there's different softwares for options back testing, for trading, shares back testing. I liked Profits Pi as Profits, Profits, Pi.com. That's what I used when I ran over 400 back tests. But what I did with my back test is, or what back testing is it allows you to create a structure, or create a system of rules. Hey, if the stock meets this criteria, it's a buy. If it hits this criteria, it's a sell, right? Here's a stop loss. Some of them allow you to do stop losses, take profit levels, and just really tweak it out however you want to. And you can have a whole different range of criteria you can implement where it's indicators. And if the price falls between this price point and out of this watch list of stocks, but you can see over the past 10 years, how would this strategy have performed? If somebody stuck with this to a T, how would it have worked? Right. And when you do that, then now you say, okay, well, look, that clearly worked in the past, and the past shouldn't give you an indication necessarily of the future, right? We say past performance doesn't predict future performance. But in reality, a lot of times history repeats itself, and the same things that worked in the past typically will work in the future. And you just keep working them until they don't work for some reason, right? Then you find a way to tweak it and adjust it so that it does work again. So I would say, if you're working on creating a trading system, back test, use the software if you can. If you can afford to use the software, do it. Or you can do it by hand. I've done it where I said, okay, when this stock, I just watch a stock and I'll just pull up a chart on Trading View and I'll go back to the beginning of the year and I'll say, okay, if I bought this stock every time it did XYZ on the chart and I sold it whenever it did XYZ, what would have happened? And I'll get a piece of paper out and a pen and I'll say, okay, that would have been a win. That would have been a loss. That would have been a win. That would have been a 5% win. That would have been a 2% loss, right? And I just keep doing that. I go out through the whole year and I say, okay, cool. So now I know that if I had did that, the strategy would have had a 75% win rate or whatever it is. And I would have had a total gain of 50, 60, whatever the percentage is, or a total loss. And I've done it where I'm like, okay, really, I won 80% of the trades, but the losers were way bigger than the winners. The winners were getting cut too short. All right. So it's different things you could do with back testing, but I will say that that's probably the biggest thing for somebody who plans on trading long term and trading their own system or creating their own system is you want to make sure you do back test so that you can find what works for you. All right, that's the video, that's the presentation. Hope you enjoy it.